All right. Welcome to Accounting 651 video lecture on corporate distributions. Okay, let's talk about distributions in general. So, dividends are largely considered what's known as an operating distribution. And that's to differentiate from a different kind of distribution, for example, a redemption or liquidation. And they're largely covered under Code Section 301A, which is Subchapter C, Part A. And you should note that there are a number of different ways to characterize something as a dividend. And certainly one of them is the income tax perspective, and that's the one we're going to focus on today. But there can be different versions of this. Financial accounting has its own version of what a dividend is. Regulatory definitions can differ. Potentially state income tax definitions can differ, and corporate law may have its own separate definition of what a dividend is. So from an overview perspective, right, when a corporation makes a payment in respect of stock out of its earnings and profits, we treat it as a dividend. So this isn't to be confused with a distribution in exchange for stock. There goes my phone. Hold on one second. So I'm thinking, the real experience is what you deserve, right? Phone call interruptions and everything. Where were we? So we're not going to confuse these sorts of operating distributions with distributions that are in exchange for stock. Those fall into the redemption, partial liquidation, and complete liquidation area. That's the territory. And we're going to cover those things. And the reason we're going to cover them is because, unlike a dividend, those include an adjustment for basis. So if you do a redemption or a partial or complete liquidation, you get to offset a part of your amount realized with a part of your basis, or maybe all of your basis. And with a dividend, you do not. So setting the stage for some of these future chapters, understand that dividends are evil, right? So from the perspective of a closely held corporate owner, a dividend is often a bad way to get your money out. There's no deduction at the corporate level. There's no adjustment for basis, which means you don't get any sale treatment for it. The only thing you have going for you is that it beats ordinary income from a tax rate perspective. So if you're, a fairly affluent corporate, closely held corporate owner, you're probably in the 37% bracket. So going down to 15 or 20, most likely 20, is advantageous to you. But knowing that you're foregoing that deduction at the corporate level to do so. Okay, so with that in mind, let's keep forging ahead. So the good news is if you're a corporate owner of a corporation, then you enjoy the dividends received deduction. Right? So that's a way of eliminating a part of the income you recognize. And we've already covered DRDs, so you should have some sense as to what those are. So once earnings and profits are spent, so once you've exhausted the earnings and profits of the distributing corporation, then the rest of it comes from shareholder basis. And then once that is all gone, then it becomes a gain to the shareholder. Okay, so remember, this is an overview, and we're going to do all these things in greater detail later on in this video lecture. Okay, so dividends cannot make E&P go negative. Now, that's not to say that E&P cannot be negative. It can. But dividends do not have the ability to make E&P go negative. You cannot distribute more than E&P, and so you end up with negative E&P. As we walk through, you'll see why that's the case. And of course, dividends can be in cash or property. I think we generally think of dividends as being a distribution in cash. But again, know that many of these rules are not built for the Cheesecake Factory, right? These are built for closely held corporations where the owners are trying to get money in and out of this corporate form. And distributions of a corporation's own stock are generally speaking, a non-recognition event. So that's like a stock split or a stock dividend. All right, so let's start with these dividends in the ordinary course of business. So they can come in a number of different forms. A common one is cash. It can also be in property. So, for example, a corporation could distribute a piece of property. It can be personal property, it can be real property, it can be appreciated or depreciated property, it could be capital gain property or ordinary income property, it could be even an installment obligation that the corporation has received that could be distributed to the owners. They can distribute their own notes. So that means that if they have debt, they could distribute debt to you as a owner, as a form of a distribution. And of course, they can also distribute their own stock out to you. So for every share, here's another share. There are also extraordinary dividends, and we're going to talk about a couple types of those in particular as it relates to a strategy known as dividend stripping. And because dividend stripping was occurring, now we have a section of code that is designed to prevent dividend stripping. So this becomes another one of the traps for the unwary. Okay, so Billy White contributes $1,000 to form a corporation. So he puts $1,000 in. And so initially what you have on the balance sheet is cash of $1,000, equity of $1,000. The corporation puts $800 of that money to work. It buys a productive asset, and that asset generates a return of $150. So when you look at the balance sheet at the end of this period, you'd say, okay, what is cash? Cash is $350. That's the $1,000 put in, less the $800 spent on another asset, plus the $150 that was generated as income. They have an asset for $800. In theory, we're depreciating that, but we're just ignoring that for simplification purposes. So the total assets are $1,150. When I look at owner's equity, that's the $1,000 that Billy put in, and $150 now of retained earnings, so that my assets equals total liabilities plus owner's equity. Classic sort of balance sheet accounting. So let's say that the corporation makes a $100 distribution from the corporation to Billy. Well, you'd argue, or the way the rules work is, you would say, well, that $100 is coming out of the retained earnings of the corporation, and therefore that's a dividend. So the corporation is taking its earnings and now flowing them through. It's passing them over to its ownership. And as a result, that's treated as a dividend. Let's say instead that the corporation distributes $200 from itself to Billy. Okay, so this is a different distribution. It's not in addition to, it's as if we're replacing that first one. Okay, so in this case, clearly they've exhausted all of the earnings of the corporation because it only earned $150. So where does that other $50 come from? Well, the only activity that this corporation engaged in was a contribution of capital. And so once I've exhausted all of the earnings of the corporation, the presumption has to be that I'm giving Billy some of his money back, right? Some of the $1,000 that he contributed, I just gave him $50 back. So this is this notion of it's a corporate distribution is a dividend to the extent it comes out of earnings. Okay, let's modify this slightly and say that in addition to all the behavior we just talked about, that the corporation goes out and borrows $200. So it says, look, I have this asset. I'll allow you to secure the loan with this asset, and we'd like to borrow $200 from you. So now cash is up to $550, and I have a liability of $200, but everything else is the same. So now my total assets are $1,350. My total liabilities, owner equity is $1,350. My balance sheet is in balance, and everything looks great. And now the corporation decides to make a $1,200 distribution to Billy. Okay, so that's interesting. So it's got to liquidate its asset. So let's assume it does that at fair market value, and it ends up with cash. So now $150 comes from earnings. $1,000 of that comes from Billy's investment, and then the other $50 came from where? It came from somewhere else. That's actually the bank's money. Now, the bank isn't going to allow this to happen, but that's neither here nor there, right? At this point, $50 that went to Billy was someone else's money. And as a result, that's income. You treat that as a gain. So this is how a shareholder treats a distribution. If a corporation makes a distribution, to the extent it comes out of earnings and profits, it's a dividend. To the extent that it's above earning profits, it first comes out of the basis of that shareholder's investment, and then anything in excess of basis is considered a gain, aka income. Okay, so 301A says corporate distributions follow 301C. What does 301C say? It says Distributions from a corporation are first a dividend, then a recovery of tax basis, then a realization of capital gain. Voila. So dividend distribution sourcing comes from 316 because we've had this simple measure of earnings. And the tax rules say, no, it actually comes from something called earnings and profits. And we're going to make you characterize earnings and profits in two ways. The first is accumulated earnings and profits. Those are the earnings and profits that have been accumulated by the corporation up to the beginning of the tax year. And then there's current earnings and profits. And those are the earnings and profits earned during the current tax year. And what happens is distributions can come out of current earnings and profits, and we'll see why that's called the nimble dividend rule in a second. Okay, so as I just mentioned, E&P, or earnings and profits, come in two parts, current and accumulated. I will not repeat those definitions for the sake of time. Undistributed E&P becomes accumulated E&P on the first day of next year. So this is the same thing as your retained earnings roll forward. So for those of you that remember your book accounting, you know that at year end you take net income, you roll it into retained earnings. The same thing happens with accumulated E&P, right? So you develop current E&P during the tax year. At the end of the tax year, once you've distributed everything out and you're done, to the extent there's any E&P left, that becomes accumulated E&P on the first day of the following year. There is no specific definition of earnings and profits in the code. There are some adjustments listed in Code Section 312. The rest of it comes through either regulations or through court cases. So what we have is a really ugly set of guidance in terms of calculating E&P. So the way this is typically done is you start with federal taxable income and then you adjust for it. So the same way we started with book income and we adjusted to get the federal taxable income, we do the same sort of approach with E&P. Most of the time, you start with federal taxable income, you make taxable income to E&P adjustments to end up with E&P. So what is the objective of E&P from a tax perspective? The idea is you're trying to identify a cash equivalent amount that's available for distribution to owners and shareholders that's premised upon economic results, not necessarily upon the taxable income base. So in some respects, E&P is more closely aligned with book income than it is taxable income. But it is definitely not book income. Okay, so let's do a quick breakdown of the four types of adjustments to E&P. So there's E&P additions for income items. So like a classic example is municipal bond income. So there's no doubt that if a corporation earns municipal bond income, that's not taxable. It's tax-exempt income. But by the same token, that cash, whatever it is also equally available for distribution to shareholders, right? It's not relevant whether it was in taxable income. The cash is still there. It's sitting in a cash account. It could very easily be distributed to owners. As a result, that's an addition to E&P. Deductions, or things that are added back items to E&P, are things like dividends that were protected by a dividends received deduction. Again, same idea, right? So from a taxable income perspective, I took a DRD, right? So I've reduced my taxable income, but that did not reduce the actual cash that went into the corporation's account. So as a result, you add back that deduction to E&P. There are non-deductible items that do reduce E&P. So a very simple one would be, how about the 50% meals limitation, right? Even though I can only deduct 50% of the cost of the meal, that's not to say I didn't spend that money on meals. Federal income taxes paid. There's good reasons why you can't deduct taxes paid when you're calculating income tax on net income. But that's not to say that the corporation isn't poorer by having had to pay federal income tax. And as a result, that is a reduction to E&P. And then there are simply timing adjustments. So these are things where the tax code permits a certain amount of manipulation to the timing of recognition of income or a deduction that doesn't match up well with the economics of it. So for example, income components, something like installment sales or completed contract accounting. The reality is on an installment sale, maybe you should just have to recognize the entire gain because you have. Maybe depreciation shouldn't be accelerated from a tax perspective. Maybe it should be some alternative system that matches more closely the actual depreciation from wear and tear or obsolescence of the underlying property. And for inventory, you just can't use LIFO. Like, why LIFO even exists is beyond me. But I guess if you have a pile of coal in your backyard, it makes sense. Okay, so let's see. We've been going 15 minutes. I'm going to do something a little bit different this time. I'm going to try to break our videos down into 15-minute chunks. So this is a chance for you to take a break, or you can go right on to the next video. That's up to you.